So let's get going here, guys. Thanks for tuning in. This is the first ever live webinar that we're going to be doing for beginners pair trading here at PAIRx. PAIRxTrader, basically, we are a new platform that's basically designed to help retail traders like yourselves try to get into the field of pairs trading, or market neutral, statistical arbitrage, whatever you want to call it. Traditionally, it's very popular in the hedge fund space and the proprietary trading space due to the fact that it's market neutral and it's a mean reversion trade, so you can really scale in and get a lot of size on. So thanks for tuning in. Bear with us. This is our first one we've done, so we're going to kind of learn as we go. So hang tight. Let's see how it goes. All right, so introduction. What is PAIRxTrader? PAIRxTrader, like I mentioned, is a new venture that we're trying out. Just to kind of, we noticed that in talking with a lot of retail traders on social media and just around, that we've noticed that, not many people even understand what pairs trading is. They don't understand that it's out there. They don't understand anything about it. And so really it's kind of, it's a great trade. So it makes sense to kind of try to bring it to the retail public and try to make light of it. So that's what we're here to do, hopefully to educate and help you guys really kind of start to get your feet wet with it. And if it's a trade that you've never even considered, maybe we can get you to kind of take a look at it and think about it. If it's something that you're already dabbling in, hopefully we can bring a lot of experience and expertise to it and really help you take your trading to the next level. Background here on us, we're prop traders. We trade in the prop space for the last decade or so. We run a small incubator fund right now as we're raising capital. So this is sort of a side project in addition to that. So the trades that we recommend here on PAIRxTrader, this is the similar system that we use. So we have developed, over the last 10 years working with our programmers and lots of quants and things like that, we've developed a system. It's more of a gray box system. It's not full black box. It's a gray box system that identifies statistical arbitrage opportunities in the U.S. equity space. And it can be used in any equity market. It can be used in any market, quite frankly. We really like to use it on the equities. It was originally designed for fixed income products, doing a lot of treasury yield curve trading and things like that, and it's been kind of adapted as we've gone, and we move it to the equity side and kind of gone there. So like I said, we're doing over 10 years of experience in this prop trading. It's been very successful. We're hitting 9 out of 10 winners probably. The loser, your win loss, the percentages are, your losing trade tends to be larger than your winning trade, but if you're winning 9 out of 10, as long as you can manage that loser well and you have smart risk management, it's a really great trade. So PAIRx is basically just a retail platform that we developed for you guys so that we can give you access to some of our trade recommendations and just different pairs that we're watching that we think have pulled to a level of statistical significance. And we'll get into that quite a bit more depth here in this video, and in the coming videos we're going to do more detailed videos. This is sort of just a generic overview. How does it work? Basically, the website's just tapped into our program, so when an alert comes out, we just have a watch list that you can sign up for, and it'll show you when we think a pair is at a point that's worth putting on, or at least worth taking a look at. What does it cost? Right now we're just dabbling with it. We're going to be doing a lot of free content on the site. We do a free trade of the week we're going to be putting out. So go to the website www.PAIRxTrader.com and you can sign up for the free trade alert. And we're going to do some random kind of webinars as well, live webinars every once in a while. There's kind of no set schedule on it. It's going to be totally free. We're going to do a lot of these videos, and these are going to be free as well. So you can get these on our YouTube page. So if you're on YouTube watching this right now, please subscribe to the website, the YouTube channel, and check out the site. You can register for the PAIRx free, and then you'll get alerted anytime a video or anything new comes out. The Pro is something we're running right now. It's $29.99, keeping it really cheap, keeping it very affordable for the retail guy to try out, to check out. We're going to have a link at the end of this video for a free trial if you're interested in taking a look at that. And again, that's going to give you a weekly recap. We're going to do a live webinar at the end of every week going over the trades, what we saw, what we liked, what worked, what didn't. Answer any questions. You're going to get the email support. You can shoot us an email anytime and we'll be able to help you out, answer questions, things like that. You get access to our watch list. You're going to get access to trade alerts too. Whenever we put something out, we think that something's hitting a target or maybe something should come on. Maybe you should take profits. Maybe you should think about puking. We're going to give you that. We're also going to give you kind of our entry and target areas and kind of estimates and places we like to kind of enter and try to scale out a trade. So that's pretty much PAIRxTrader. So if you're interested, take a look. If not, stay tuned because we're going to get into just straight up pairs trading 101 here. So what is pairs trading? Well, pairs trading basically is exactly like it sounds. I mean, you're trading a set of two stocks or pairs that basically over time have exhibited a great, relationship. And what you're doing is you're not betting on whether they're going to go up or down. You're basically betting on the fact that that relationship is going to hold steady. So an example, would be HD Low, right? So that's Home Depot, Lowe's, Coke, Pepsi, American Airlines, Delta. So these stocks just inherently make sense, right? Actually, some of these pairs are maybe not even very good from a statistical standpoint, but we'll get into that later. But just from a general concept, this is what you're looking for. Two stocks that have very similar business models. That's Nordstrom, Gap, Comcast, Fox, Verizon, AT&T, Visa, MasterCard. Two companies that are very similar, have a lot of the same different forces that are acting on them. So, they're going to be both US-based stocks. So things that affect the domestic US are going to affect both of them, equally in theory. Again, so we break it down, we match up among sector and industry. So we make sure that if something happens that's bad for airline stocks, well, American and Delta should both get hit exactly the same, even if there's news for the airlines. So airlines could get hit and those could be down 8%, but hopefully they're both down 8%. And then your actual pairs trade doesn't make a change. All you're doing is trying to isolate the relationship that we've deemed has pulled to a statistically significant level. And then we come in and we try to buy one and we sell the other and we wait for that relationship to revert back toward a regular level and then we take profits. That's exactly what we're trying to do. A lot of people like to use this drunk dog, a drunk and his dog analogy, where, if you look at a drunk guy walking home from the bar and he has his dog, and basically the way it kind of goes is you don't know where he's going to go. His actions are completely random, and the dog's actions are seemingly random if you just look at them. And they can both, walk side by side, or they can kind of venture off. But in theory, the dog is always going to come back to the guy at some point. You don't know when they're going to deviate. All you know is that there's a relationship there between the two. So whatever kind of weird movements they're making or which way they go, or if the dog decides to move away from him for a while, we know historically that they're going to walk together. So what happens is when the dog gets far enough away, what you want to do is make a trade that the dog is going to come in. So in that scenario, you'd be selling one, you'd be buying the other, and you're hoping it comes back in. To me, I like to liken it to sort of a missing dog, in the sense that, if when you watch these pairs over time, you start to understand them and really understand how they move and what's a normal move for that pair, what's different, what's unique, is this unusual? Is this something that is routine and I can take advantage of? Is this an opportunity? Or is this something that's going to blow out on me? And that's where, to the outside guy who doesn't trade pairs very frequently, he can kind of be confused. And that's where the missing dog concept comes in. Basically, the idea is, maybe a dog runs away and the first time it happens, you're scared and you don't know what's going on, but then he comes back. Okay. And then it happens a few times more and more and more. And as you start to see this, what happens is the next time the dog goes away, you're no longer concerned and scared and fearful of it, right? And not wanting to participate. What you're doing is you see an opportunity. You know the dog's going to come back. In theory, now it doesn't have to. Something could happen to the dog. He could get lost. Something could happen and he doesn't come back in. And that same thing can happen with a pair. The pair doesn't have to revert in. It's not a true arbitrage. It's not a guaranteed profit here, right? But that's what we're talking about, mean reversion, statistical arbitrage. We're betting that this is going to hold this relationship and that it's going to come back in. Okay, so with the missing dog, when my dog runs away, if I know that this is just routine behavior for him and he's always going to come back, and you look at it and say, "Oh, scary, he ran away," I would love to make you a bet that, hey, no, I bet you he comes back within the next 2 days, because I know historically that's been his pattern. So that's kind of the way that I kind of like to think on it, I guess, if I'm using dog analogies. But that's really what we're doing here. We're trying to bet on the relationship between two stocks and for them to come back in toward an average. Now, how do we know what pairs to trade? That's coming up. How do we know when they've pulled to a statistical level that's important that we can actually enter a trade? What's an opportunity? We're going to get into that as well. How do we manage them? How, ideally you want to run a portfolio of these and you don't want to just take one opportunity. You want to take a lot of them, as many as you can get. And so we're going to get into a little bit of portfolio management too as we go. But this is just kind of trying to give you kind of a real high level right here on what the general concept is. So let's look at a few examples. I got a few charts here we can look at to kind of just explain in a little bit more detail. So here we have a daily trading chart. I don't know why I said trading, that sounded weird. Trading View chart, tradingview.com. It's a great free website. It's like free stock charts. I prefer this one. So what we have here is Home Depot versus Lowe's. And this is a daily chart. I don't know how far we're going back, but what you can see is a clear relationship between the two, right? The general trend is up, obviously. Here, they're trading real tight, little deviation here. They get back in line. What is this? Home Depot, I think, pulls ahead for a while, whatever. And then here we get back into chop, and you can see it's almost an overlay of the charts. And that's what you're looking for. You want them to be nearly identical charts with the occasional separation. If you trade something that's like a true arbitrage, like if you should trade something that's A shares versus B shares, what's going to happen is they're going to overlay like this, and they're never even going to create trading opportunities. And if they do, they're going to get eaten up by algos, and it's not even worth it for people like us to try to get involved. When we start talking about these large stocks that have a lot of volume, these things they can move, and they can kind of, if you're on top of it, you can get a lot of opportunities. You'll see that they crisscross too. That's another great sign, right? So the blue and the orange, I mean, they're crisscrossing. There's no, and then this gets ahead, and then suddenly, this isn't, this is where you want to be in. And you want to see crisscrossing. You want to see a lot of that stuff. Again, we'll get into that more. Correlation between the stocks is important, but the co-integration factor is really what's important, in my opinion. And seeing that those relationships do ebb and flow, and they come back in. That's something we want to look for. Here's another one, Bank of America, JP Morgan. Again, very similar charts. They change, and they're not perfect, but they're very close. I mean, and it makes sense from a fundamental standpoint that they're going to trade similarly, but they do have their own driving forces that affect the individual stocks. So there's going to be times when they do deviate, and we want that. That's opportunity for us. So we look for that. There's also going to be opportunities for liquidity and things like that. If you have a hedge fund liquidating a huge position in Bank of America, selling tons of it, and the stock is getting hit, JP Morgan's going to come down with it, obviously, just because the whole sector and industry are going to come down. But it's not going to come down as far. So you're going to get this spread. And if you're on top of it and you know what to look for and all that kind of stuff, you can really look at it and have a great opportunity. This has been a pair that's been really great to trade for last couple of years. Now this is one that's interesting. Coke and Pepsi, who you would assume it's a great pair to trade. Makes a lot of sense from a high, just thinking on them. But you do have to kind of realize that in looking at trying to figure out what pairs to trade, there are different drivers here. Certain companies. Pepsi, I think, they own other things outside. It's not just Pepsi Pop versus Coke Pop. I mean, Pepsi as a company, Frito-Lays and whatever they own a bunch of food products and stuff like that, I think. But, so that changes things. If a company has a lot of European exposure, that can have a huge impact on this stuff. So there's definitely fundamentals that are going on here that can cause a pair to break down over time. So you constantly want to be checking them. You constantly want to know that a pair is still in play, it's still good, and that your initial test to find out what pairs you like. And again, we'll get into that as we go. You want to make sure that those are always staying put, because you don't ever want to get into a scenario where that's going to be your loss, right? Because when a pair does move and it stays out there and it doesn't come back in. And that's where you just have to have good risk management. And there's a number of ways you can kind of manage that risk that we'll get into later. So why trade pairs? Well, like we just mentioned, there's no directionality, right? That's really the big selling point here. You're buying and selling an equal amount or an offsetting amount of the stock. So you're buying $10,000 worth of American Airlines, and you're shorting $10,000 worth of Delta. So the idea here is that the market can go up, it can go down. It doesn't matter which way the market goes because you've netted out your exposure to the market, right? You don't have a beta exposure here. So when the market rallies 10%, well, your long is going to win 10%, your short's going to lose 10%, and you're going to be net zero. That's what we're looking for. All we want to do is bet on this relationship to come back and play. That's a very common technique in the proprietary trading space, the hedge fund space. It's huge in fixed income. And again, in the equity world, it's really great if you can do it right and kind of it's very popular. It's just not common. The retail traders don't tend to understand this. You don't have to buy breakouts. You don't have to short penny stock parabolic moves. There's ways that are more, scientific, if you will. I don't really like using that term, but there are smarter ways to trade that are more of a system than just trying to kind of trade flag breakouts or whatever people out there are trying to do in the world. Not time sensitive. So again, like a lot of these other things you see out here on social media, a lot of them are trying to catch breakouts or time sensitive trades that if you're not in them, you're going to miss them. They send out trade alerts and they're already in the trade and they're getting front run and the whole nine. These are more of a swing trade, right? So when a pair starts to pull out, it'll pull out over a couple of days, maybe a week or two, it depends. And what we want to do is find these pairs that have pulled out on a longer time frame, that are at a good level, that have room to come back in, but have also made a sharp aggressive move on the a shorter time period, so that we can get a quicker trade. But the trade's still going to last. We can take a trade off in one day. It happens. It's not that common. We don't like to do that. Ideally, 2, 3, 4 days is kind of the time frame you want to see these come back in. But we can hold the trade for 2, 3 weeks, up to a month, and depending on if there's earnings coming up and some other things. But, so you can really take your time on these trades. They're not going to burn up day trades. You don't have to worry about the pattern day trading rule here. Just not an issue, And so, again, another reason that this is kind of nice to trade the pairs. There's no emotion in this either, right? You're not seeing something, looking at it, and having to make a decision whether you jump in or not. You can take your time. You can do your research. You can be methodical about it. You can make sure it's a pair you like. You can do your research. And when everything is good and you like it and you've done your research, you can take your time. You can get in. There's no, speed required here. You don't need to have co-locations on your servers to get executed. We're not talking about, your fills don't matter, quite frankly, to be honest with you. And Tesla, when you start talking about size and you can talk about, take fees and things like that, that kind of changes things. But for the most people, the retail guy, none of that matters. And probably one of the most important reasons is it's very easy to learn and execute. It's simple. You can watch our free videos we're going to put out. Subscribe to us on YouTube. By the time we get done with this beginner series, you're going to be able to trade this stuff. And in theory, you should be fine. You should be profitable if you just follow exactly what we're saying to do. It's very simple. This isn't something that you can watch forever and think you understand. Then when you go to actually try to implement it, it doesn't work. You're missing things. It's very simple. The pairs, as long as you find the right pairs, as long as you're trading the right pairs and you're waiting for the right opportunities, you'll be amazed at some of the results that you can get in this. Um, and the biggest kicker for us, for a lot of, that's why it's so popular in the hedge fund world and the proprietary trading space, excuse me, is the scalability. You can run, there is no limit to how much money you can run in an equity market neutral fund. You can absolutely run a $100 million fund without even blinking an eye. We can run $1 billion and be fine. And it doesn't change the strategy. It doesn't force you to change what you're doing. You know, there's a lot of different people out there running money, whether they're CTAs or prop funds or hedge funds or whatever they may be, and guys who can, if you get too big too quick and you don't scale appropriately, you can run into a lot of headaches. And the beautiful thing about pairs is that's not really an issue. If you're shorting parabolics, for instance, you can only get so big. Can you get borrows? And you're trading these penny stocks that you can't get borrows in, and you can only get so many. You might want to borrow 20,000 shares. You can only get 1,000 shares. That limits the ability for you to run size. Tim Sykes, I think, ran a $3 million fund, and I think he was saying that he couldn't get any bigger than that. And to his credit, it's not his fault. That is an inherent problem with the trade. And it's not to say that you can't be extremely profitable doing that stuff and you can't make great money doing it. You just can't. You're not going to run $1 billion hedge fund doing that strategy. So the sky is sort of the limit here with pairs trading. All right, so we're going to get into what makes a good pair here. This is a pretty big section, so we're going to take a little break here. We're going to come back. We're going to dive into this. We're going to talk statistics. We're going to talk correlation, co-integration. We're going to talk different ways to kind of weight the pairs and how you can do it, and a lot of that stuff. So stay tuned. We'll be right back. Thanks.